The Gartland Group presents Taxes, the IRS, and You with your host, Bernie Gartland. Taxes, the IRS, and You is a different kind of show that'll help you solve your tax problems. As former Deputy Attorney General of the state of Delaware and with over 25 years of experience as sole practitioner in both Delaware and California, the name Bernie Gartland has become synonymous with taxes. And now your host, Bernie Gartland.
Hey everybody, Bernie Gartland. Name of the program is Taxes, the IRS, and You. And we call ourselves a very eclectic, different type of show. What I mean is this. For every single week we're here, we're going to present different and new topics that probably you don't even know or understand. For instance, one of the things we did quite recently was the concept of dischargeability of taxes in bankruptcy. Well, everybody knows you can't discharge taxes in bankruptcy. Au contraire, you can and always have been able to. Certain taxes are dischargeable. The problem is when we did that program, we never did get into the aspects of what a Chapter 7 and a Chapter 13 are and what are the qualifications for each. Forget about dischargeability of taxes in bankruptcy. Let's talk about consumer debt. Let's talk about Visa, MasterCard, JCPenney's. Student loans, are they dischargeable? What about all these issues? That is what we're going to cover today. By the way, if you go into the bankruptcy code, you will find there is a Chapter 12, a Chapter 9, a Chapter 11, a Chapter 7, and a Chapter 13. Now, our panel member today, Bill Howe, who's part of Gartland Law, we will talk in the third segment on something called a Chapter 20. Now, go find that in the bankruptcy code because there is no such thing as a Chapter 20, except we do Chapter 20s 2-3 times a month. So we're going to talk about that. So stick around for our third segment, and we're going to talk about Chapter 20 because that is kind of like what is the solution for some of our strategy, and it's an incredible strategy. So I want you all to say hi to Bill Howe. He's sitting here with me. He is a member of Gartland Law. He's an attorney. He's been an attorney for a long time. And he is the bankruptcy guru of Gartland Law. Now remember, we have the Gartland Group, which is a bookkeeping company called Griffin Bookkeeping, Gartland Law with David Wiesen, tax attorney, and Bill Howe is bankruptcy attorney, and then American Tax Centers, which Brian Bauer, who is an enrolled agent, does all your tax work. And by the way, there's a segue from the bankruptcy department into the American Tax Centers, and Bill Howe will explain that because there's certain requirements. So anyway, welcome, Bill.
Thank you.
Yeah, we are here. We're going to talk about Chapter 7s and Chapter 13s, and as you heard in my monologue, okay, we covered a few weeks ago the aspect of dischargeability of taxes in bankruptcy, but we didn't talk about what a Chapter 7 really is and what a Chapter 13 is. So can you kind of give the folks a little bit of background about yourself, and then let's talk about what is a 7 and what is a 13?
Yes. As you said, I'm a bankruptcy attorney. I've been practicing bankruptcy law for 20-25 years, and my practice is limited to doing that. I've done hundreds, if not thousands, of Chapter 7s and Chapter 13s. Mm-hmm. Now, a Chapter 7 is a quick way to get rid of your debts. It's what it's for is to discharge your dischargeable debts. You file a Chapter 7, assuming you qualify, you get a discharge in about 90 days. And certainly, I know a fellow bankruptcy attorney down in San Diego who likes to say, file a 7, go to heaven. In any event, many times a 7 won't do the job and you need to go into Chapter 13. Without going into the details of why that would be, a Chapter 13 differs from a Chapter 7 because it takes a long time. It pens for 3 to 5 years, and during that time you make payments to a Chapter 13 trustee. You get a discharge at the end of the Chapter 13, assuming that you've made the plan payments called for. But you don't get that discharge till the end of the 3 to 5 year period. Whereas in Chapter 7, you've had your discharge 3 months after you got into it, and you've on about your business.
And you get your life on with.
And you get your life on with.
You know, it's curious that I was listening very carefully to you, is that in you say, you can file a Chapter 7 if you qualify. And I was kind of laughing to myself because prior to the 2005 bankruptcy revision disaster, sponsored by all those people on Wall Street who ended up pulling the rug from us anyway, it never was if you qualify, because now it's all what you're earning and what you're not earning, and what your relationship with your family is, et cetera. It's very interesting. And I want to point out to the folks that in the late 80s, I was doing tax problem solving, and I was doing it very well. I probably didn't know as much as I know now, but I was doing it, and I uncovered something. Oh, Judge Hargrove. Okay, one of the San Diego bankruptcy attorneys, judges, that I went in there and we got rid of over $60,000 in taxes. The problem was I didn't know what I was doing with doing the forms and the applications and everything, because I was a tax attorney, and every time I went to court, they always found something wrong with my application or whatever. So I called you all the time, didn't I?
Yes, you did.
Yeah, I did. And I picked your brains all the time.
And most of the time I told you straight.
Yeah, I know. And sometimes, but I didn't appreciate your secretary saying, "Are you calling again?" No, I'm kidding. Okay. So what happens is that you and I have known each other for all these years.
Yes, we have.
And what makes our union so important is that you developed your practice on, I call the consumer commercial bankruptcies. You know them inside and out. Where I went in a different way, I went through the tax problem solving, the tax bankruptcy. And with the 2005 Bankruptcy Act, I became less than efficient in preparing the forms, but very proficient in the tax problem solving and tax bankruptcy. And that's when we joined forces.
Yes.
Because I saw the need for what you do and what your strengths, and you saw the need for my strengths. So what we did, we joined forces, and it has been a great union. And what I'm trying to say to the people out there, if you have a tax problem that you want to talk about, a tax bankruptcy or a consumer issue with bankruptcy, we got you covered.
That's
we got
right.
you covered. So what we're going to do is we're going to go, in the next segment, we're going to go into more of the ins and outs of what you have to do for a 7 and why you may not qualify for a 7. And then this disastrous thing about, just remember, 360,000. Folks, 360,000 is a magic number. And you're going to see why sometimes you can't do either one of the bankruptcies because you don't qualify under it. And I'll tell you that one of the things that you and I both adhere to is we are not going to tell people what they want to hear about bankruptcies. Right. We're going to tell them what reality is. So when we come back, folks, what we're going to do is we're going to talk about the ins and outs of a Chapter 7 and the ins and outs of 13. And then the third segment, we're going to talk about strategy involved, especially utilizing
Chapter 20.
Chapter 20, which doesn't exist. Okay. Anyway, be right back, folks. Hi, folks. I'm Bernie Gartland, and I'm so proud to introduce you to the Gartland Group. Do you have a need to have your current or prior year tax returns prepared? Is the IRS knocking at your door and you need legal representation? Do you need professional bookkeeping services? The Gartland Group can help. Let us put control back in your life and have that control give you a future.
Call today for a free consultation. 760-345-1500.
Facing bankruptcy has led many people to believe it was the end of the line, when in fact it was their doorway to a new beginning. Hi, I'm Bernie Gartland. For a full explanation of what a Chapter 7 or a Chapter 13 bankruptcy is, call me today for a free consultation. Hey, Bernie Gartland here. Name of the program is Taxes, the IRS and You, and we're I'm sitting here talking to Bill Howell about Chapter 7s. Let me see. That's the topic we're talking about today, isn't it?
Yes, it is.
All right, so we're going to go a little more in depth about a Chapter 7. There is a Chapter 7 which is called a fresh start, full liquidation of what you can discharge, and a Chapter 13 for other reasons. Now let's talk about a 7. There are certain qualifications for a 7.
Yeah, since 2005, the Congress has imposed a means test, so-called, so that if the means test is an objective test, that you have to give, or that I would give to the debtor. And if the debtor has, in effect, too much income, called disposable income, then the debtor does not qualify for Chapter 7 and cannot file a Chapter 7. The answer then is to look at Chapter 13.
Okay.
Assuming that a debtor did not have disposable income and could qualify for Chapter 7, the next issue is to look at the debtor's assets.
Okay.
There is a set of exemptions. In California, there's 2 sets of exemptions, and usually, in most cases, the exemptions will cover all of a debtor's assets. So that a debtor could file and not lose anything. But if a debtor has non-exempt assets and chooses to file a Chapter 7, a Chapter 7 trustee who would be appointed to the case would take those non-exempt assets, and if they're not cash already, would sell the property, convert it to cash, and then use it to pay the debtor's creditors, or
Right.
all or part of the creditors.
Right.
So in many cases, if the debtor knows in advance that this is going to happen and
Right.
say, fine, I'm willing to do that, that's great. If a debtor does not understand that's going to happen and he's surprised at his
Right.
meeting of creditors, that is not so good.
Yeah, and this is interesting concept because I've talked to a lot of bankruptcy attorneys and also what I call the, quote, paralegals
Yes.
that cannot give legal advice, and usually the client ends up in a lot of trouble. And you and I worked a case that a guy ended up in massive trouble. But the concept of Chapter 13 is take a look at what the person's income, if they qualify under the means test. Then they qualify for the 7 under the means test. But take a look at the person's assets. In this day and age, most of the clients that we have coming in really don't go over the exemptions, okay? And there are exemptions like a homestead exemption
That's
for
true.
value in a house, but nowadays there isn't any value in a house, and then you end up looking at you have car exemption, tool exemptions, Bible exemptions, and then there is something called a catch-all. Can you explain what the catch-all is?
Yes, there's 2 sets of exemptions in California, and it's called a wild card or catch-all
Right.
exemption that is used for any property that the debtor has.
Right.
It's limited in amount, around $23,000 plus $3,500 or so for a vehicle, one
Right.
vehicle.
Right.
So, assuming you have a vehicle of some value, you've got maybe, what did I say, 25, 26,000 that can be used for anything. And that's usually enough to cover, because household goods, clothing, jewelry, things of that nature come under an additional exemption in addition to that.
And this is all in the Chapter 7. And what I want to impress upon the folks out there is this. When we do an analysis of a Chapter 7 for you, this is what we do. We take a look at what debts you owe. Visa, MasterCard, JCPenney, student loan, arrearages on child support, arrearages on alimony, and certain taxes. And we take a look at what your income and your expenses are, and we say, okay, you are now qualified to do a Chapter 7 bankruptcy. Now, you may have some assets that are exempt under the catch-alls, and there's certain caveats that I have to tell you about, especially if the IRS has filed a lien, that those assets may not be taken by a trustee in bankruptcy, but the lien on taxes would survive, so you have to deal with them in a little bit later after the bankruptcy. But let me also explain something else. Bill, the way that I explain when I interview, and you have to make a point about what a trustee does, okay? Because once you file that Chapter 7, that
Yes.
trustee takes control.
Yes. Once a debtor files a bankruptcy in Chapter 7, his entire estate belongs to a trustee who will be appointed to the case.
Right.
Now, as a technical matter, a creditor committee could come in and take over from the trustee, but that almost never happens.
Okay.
So whatever trustee gets that case, it comes up on rotation, then the estate belongs to that trustee, subject to the debtor's claim of exemption, so that if the debtor can exempt all the property, then the trustee isn't going to sell anything, and he will allow the debtor's exemption exemptions to go forward, and that'll be the end of it. If the trustee finds no assets, he will issue a so-called no asset report saying that he's looked at the thing and he doesn't see anything. It might be interesting to know that when you file a bankruptcy, you pay a filing fee of $306, which is, I think, a little pricey. But $60 of that money does go to the trustee when he files his no asset report. Most of the bankruptcies are no asset cases.
And this is another salient point that and I'm glad you brought that up because this is something that I impress upon people, is that when we put somebody into a Chapter 7 bankruptcy, and I want to emphasize that we spend time with the clients to make sure they understand everything, they get copies of everything, and whether or not there's going to be a problem. Because the client always has the right to make a decision whether they want to proceed. If they say, okay, well, I want to take a shot at this anyway. That's your prerogative. But remember something. The bankruptcy estate, a Chapter 7 bankruptcy estate, I always draw a picture like this. And there's people assigned to this. There's the debtors over here, the creditors over here, and there's this administrator called a trustee. His role is to make sure everything goes correctly. His role also is to take into this bankruptcy estate any and all non-exempt assets, sell them, and give them on a pro rata basis to creditors. Now, when I say to the client, according to what Bill has analyzed for you, you don't have any assets that we really are worried about. And so they said, well, how long is this case going to be open? And I say, well, let me ask you a question. As long as the trustee works this case, he gets $60. How long do you think this trustee... Remember, the only way the trustee makes anything more than $60 is by selling assets and taking his percentage and distribute. How long do you think he's going to work your case for $60? Especially since the court sends out a notice saying this is a no-asset case. Okay, so it seems really good for a client when they know what they're talking about. I
want to make one salient point about the interview that I do with the client. I do an in-depth interview. I do not charge for that consultation, and I think that's important that the client understand that. Right. I don't come and charge you money to tell you you're not a bankruptcy candidate. Right. I charge you nothing to tell you you're not a bankruptcy candidate or you are a bankruptcy candidate. I think it's very important that the client be able to come in, speak freely, tell his whole story, take as much time as he needs without worrying about nickels and dimes. This is exactly what I was going to say, is that the clients go to a lot of the bankruptcy firms around, and especially paralegals. Oh, yeah. Which, and the problem is they don't spend the time with the client. In fact, the one paralegal who the U.S. Attorney's Office he may end up prosecuting them. We had a hand in one of the cases where he flat out told the client not to put down $50,000 that he had hidden under the mattress, and the trustee found out about it. And I will tell you, all broke loose. Everything. Ladies and gentlemen, when we come back, we're going to talk about a Chapter 13, and then we're going to talk about how a 13 and a 7 becomes a Chapter 20, and under what circumstances. So we'll be right back. Hi, folks. I'm Bernie Gartland of the Gartland Group. I want to introduce you to tax attorney Dave Wiesen.
Thanks, Bernie. Gartland Law is the tax problem-solving arm of the Gartland Group. If you're facing a tax levy, an audit, or if the IRS is knocking at your door, we can help. If you're facing foreclosure or want to know your bankruptcy options, we can help.
Let us put control back in your life and have that control give you a future.
Visit us on the web at www.gartlandgroup.com.
If these 4 areas are controlling your life, let me show you how through either a Chapter 7 bankruptcy or a Chapter 13 bankruptcy, we can put control back in your life and have that control give you a future. Call me today for a free consultation. Anyway, hey everybody, welcome back. Bernie Gartland. The name of the program is Taxes, the IRS and You, and presented by the Gartland Group, which Bill Howell is a tax attorney, a bankruptcy attorney in the Gartland Law, and he's part of the trilogy of the Gartland Group. We're sitting here talking about Chapter 7s and Chapter 13s, and one of the things that, Bill, I forgot to identify is that student loans, rearages and alimony, some taxes, and a couple other areas are not dischargeable in bankruptcy. So when you do your analysis, I know you do this, you go through this with the client and say, these are areas that are going to be discharged, but these are not, so that they have full information. Now, when one doesn't qualify for a Chapter 7 for whatever different reasons, and sometimes the court says, sometimes you file a Chapter 7 and the court sits there and says, we are not going to allow you to do this Chapter 7. What happens?
Not when I filed a Chapter 7.
Okay. But it does happen to some people.
It does happen to some people.
Then what happens?
You want me to follow with that? It would get converted into a Chapter 13.
Okay. And what is a Chapter 13?
A Chapter 13 is a scheme under which you pay payments to a Chapter 13 trustee to pay off a certain amount of debt. There's a couple of things that are pertinent in figuring out what's got to be paid in a Chapter 13. There's a thing called a Chapter 7 liquidation analysis. So you got to pay at least as much as a trustee in Chapter 7 would get and pay creditors.
Right.
The next thing is to look at your income. And depending on your income, you may have to pay more than a basic liquidation analysis. Mm-hmm. In Chapter 13s that we get a lot of, you may have to struggle and pay quite a bit in Chapter 13 because of the priority tax situation. If you've got recent taxes, I won't go into all the details, but if they're so-called priority taxes, they have to be paid 100 cents on the dollar in a Chapter 13, regardless of the liquidation analysis, regardless of your ability to pay. And you may have to struggle to do that, but it's a whole lot better than having the IRS come at you outside Chapter 13.
Okay, so Chapter 13 basically is what I call a poor man's reorganization plan. In other words, when you don't have the big money to go into a Chapter 11 like Wicks Lumber Company or American Airlines or United Airlines, the Congress came up with this thing called Chapter 13 wage earner reorganization, which ended up that even a self-employed person could, or somebody on alimony could go into.
Anybody with regular income.
Regular income. And what it does is it sets up a 5-year plan, 3-year to 5-year plan that you can pay your creditors. It started out that you paid your creditors every penny on the dollar until a wonderful judge in San Diego by Louise Malugian DiCarlo, I don't know what she's been married 2 or 3 times. She represented a Adler, a Mr. and Mrs. Gebb. And the Ninth Circuit Court said it does not have to be paid back dollar for dollar. Right. Now, you and I can have lots of discussions on what the Riverside, the Central District does, and they don't like 0% plans and 30% plans, whatever. That's a discussion for another day. But you know that secured creditors have to be paid dollar for dollar plus some interest. You know priority creditors, whether they're arrearages on alimony or some other areas such as priority taxes. But then there's a general unsecured.
That's right.
I euphemistically say, and I know this is not the total correct analysis how you word things, but it's like I say, all right, whatever the disposable income is, the secured creditor and the priority creditor has to be paid, and what's ever left over, the general unsecured creditor gets, whether it's 10 cents on the dollar, 20 cents on the dollar, 30 cents on the dollar, 40 cents on the dollar, 70 cents on the dollar. The problem we have with those, or 0% on the dollar, 0% plan. The problem we have, Bill, as you know and I know, the court in Riverside County does not like that, and they say, all right, let's do an analysis of the income and expenses, because they're always going to try to find more money to pay during the plan. But the concept of getting a plan put together for a 5-year period so nobody can come after you, would you explain Section 362 and why that's so important?
The automatic stay.
Yeah.
And that also pertains to my bankruptcy experience in San Diego was primarily as far as Chapter 13s go, was to stop foreclosures and allow someone to reinstate their home loan through Chapter 13, taking 3 to 5 years to do so. The Section 362 is what allows that to take place. 362 says all foreclosure action has to stop as long as a plan is confirmed in the bankruptcy court. Judgments stop, lawsuits stop, garnishments stop, bank levies stop. Any adverse action taken against the debtor stops, and upon a confirmed plan being put into place, whatever those creditors are going to get is taken care of in that confirmed Chapter 13 plan.
And my priority is Section 362, in addition to that, stops the IRS from coming after somebody. Now, let's say hypothetically that a person owes more than $360,000 in general unsecured creditors. They can't qualify for Chapter 13, can they?
That's true. There is an escalator clause. It's $360,000 plus a few dollars more of unsecured debt. But there's also a secured limitation, which is $1 million plus an escalator of $24,000.
Let's say hypothetically, in my hypothetical, that you got a client that owes $600,000 in credit cards, judgments, and everything that cannot qualify even to go into a Chapter 13. So now, ladies and gentlemen, watch the segue. What do we do in terms of doing a 7 and a 13, and 7 and 13 equals 20, doesn't it?
Yes.
How does that do? Because we got a couple of minutes left. Let's go into what a Chapter 20 is and why we strategize for the client.
Yes. In situations where there's say taxes, priority taxes, a lot of priority taxes. But you can't go straight into a 13 because, as you say, the debtor owes too much money in unsecured debt. There's no limitation in Chapter 7.
Right.
So the debtor can file a Chapter 7 and discharge all of the general unsecured debt.
That gets him down under the 360.
Yeah, he won't discharge the priority tax debt, which he still has to deal with. So once the Chapter 7 bankruptcy is discharged, then he's free of the general unsecured debt and only has to deal with let's in this example say it's just taxes. It's priority taxes. Right. It's $100,000 in priority taxes.
So he paid over a 5-year period.
He can pay it over a 5-year period. And here's the nice thing about that. It's a 100% plan.
Yeah.
The judge loves it. The trustee loves it.
And the interesting thing is that I listened to the state of California bar where a young lady said, and I was waiting for a comma, and she commented further, but she didn't. She said, and I was getting my units for continuing education. She said, and remember, folks, you cannot file a Chapter 13 after a Chapter 7 for 4 years. And I was waiting for the comma. And she stopped and went on another subject matter. And I'm saying, oh, my God, this was a representative from the Bar Association. Ladies and gentlemen, the reason I bring that up is that you will talk to a lot of bankruptcy. First of all, you talk to a lot of bankruptcy attorneys that tell you can't discharge taxes in bankruptcy. Yes, you can. You always can, 507 and 523. But here's another aspect. What the code says is you can't file a Chapter 13 after a 7 to get a discharge unless 4 years have gone by. But in the scenario, so well put, that the priority taxes are paid dollar for dollar over, and it's done. You don't have to worry about it anymore. Ladies and gentlemen, thank you, Bill, for coming, and we'll see you next week.